Altria Group, ticker MO, is currently trading at $44.36 and is down by 30.52% over the last 5 years. Since 2020, the company has been on a steady rise and rose from $34.28 all the way up to $44.36, which is about a 30% increase. Now, to really understand whether MO is currently trading below its intrinsic value and is indeed a buy now, we'll have to jump over to my fully automated stock analysis tool, where we will plug in the ticker symbol for Altria Group and wait for all the important metrics to show up. Now, to further analyze this company, we will have a look at the 9-pillar analysis, Graham's formula revised, the discounted cash flow model, multiples valuation model, and the dividend discount model, which will all lead to our ultimate valuation at the end. Now, to jump back to the stock screener, the first thing we can see is that the dividend yield is currently sitting at 8.48%, which is a really good dividend yield. We can also see the dividend payout is at $3.76. Now, the thing I don't like about MO is the very high payout ratio. I generally like the payout ratio to be below 70% and even better when it's below 50%. A payout ratio above 100% is kind of a red flag to me, so we have to take this in mind. Here we can see that the analysts currently project a price of $50.65 for the end of 2023, which is about $6 higher than the current trading price. We can see the beta of MO is at 0.6, which shows that it's less volatile to changes than the overall market. Here we can see the income statement and the cash flow statement, where the income has been increasing quite well and the free cash flow has decreased only by a little bit. And here we can see that the total equity increased as well by quite a bit. Now let's jump to the 9-pillar analysis and have a look at MO. Let's just plug in the symbol real quickly and wait for all the metrics to appear. Now, as we can see just from scanning the screen here, MO is doing pretty well with a rating of 8 out of 9. We can see that the 5-year P ratio is sitting just about at 16.61, as well as the price to free cash flow sitting at 9.89. Now, the 5-year P ratio, 5-year profit margin is at 51.86%, a very good profit margin. We have a really good consecutive dividend growth over the past 8 years or so at 7.88%, which means that the dividends have really been growing over the past few years. Long-term liabilities over the 5-year free cash flow should be below 3. In this case, it is below 1 at 0.80, which means that the firm can pay off their long-term liabilities with their 4-year historical free cash flow. Now, the net income has been increasing by more than 100% over the last 5 years, and we also have an increase in free cash flow at about 14.54% over the last 5 years. In the middle here, we can see that the shares have decreased by about 1.25% from 2022 to 2023, which is great as well. Now, the only metric that is stopping MO from reaching a perfect 9 out of 9 score is the revenue growth, which has decreased by only 0.35%, so that's not really that big of a deal. Now, we can move to finding the intrinsic value first using the Graham's formula revised, where we will plug in MO as Altria's ticker symbol. This will give us an intrinsic value of $33.57. Now, to get this value, we took the earnings per share, base PE, 5 years earnings growth estimate, growth rate multiplier, average yield on AA Corporation bonds, and divided everything by the current yield on AA Corporation bonds. Now, this value is 32% lower than the current trading price, mainly due to the low earnings per share of MO. Now, let's jump to the discounted cash flow analysis, where I've already plugged in the ticker, which automatically calculated the free cash flow over the last 10 years and gave me the average growth rate at 10.84%. Now, to move to the next step, we have to calculate the growth rate of the free cash flow for the next 10 years. And based on the average growth rate and the analyst growth rate projections, and based on my own research, I calculated the growth rate of about 4.7% would be fair. Now, this calculates the future free cash flow over the next 10 years. Now, to calculate the present value of that future free cash flow, which we will use to get our intrinsic value, we have to calculate the discount rate. And I based the discount rate on the WACC, which is calculated right here, and on the 9-pillar analysis we did prior. Based on the WACC and the 9-pillar analysis, I'd say that the discount rate of about 7.8% would be fair. And this would give us an intrinsic value of $92.07. Now we can move to the next valuation model, which is the multiples valuation model. Here we will compare Altria Group to MMM, BTI, and Phillips Morris. Now, this valuation is based on comparing the company we are evaluating to companies which operate in the similar sector. I take these companies' price per earnings and average them out. I then multiply this average with the earnings per share of Altria Group to get an intrinsic value of $38.25, which is about $7 less than the current trading price. Now let's move to the final valuation model, which is the dividend discount model. We plug in our ticker right here, MO, for Altria Group, and get the dividend payout for the last 5 years and the yearly dividend payout for the last 5 years. We have the growth rate calculated right here and the average growth rate calculation right here. Based on that, I project a growth rate of about 3.7% for the next few years. This would calculate an intrinsic value of $318.20, which is obviously not the correct value. And if you have a look here at the formula up here, to calculate the intrinsic value, we take the next year's dividend and divide by the WACC negative the projected growth rate. Now when the WACC and the projected growth rate are a similar number, a similar percentage, the intrinsic value we calculate does not make any sense. Therefore here I have an alternative model which takes the next year's dividend, the stock price next year, and the WACC to calculate an intrinsic value which is more reliable than the value calculated using the dividend discount model when the WACC is similar to the projected growth rate. This gives us an intrinsic value of $51.89. Now we can move to calculating the ultimate value. We plug in MO right here. And we can see that the Grams formula gives us 33, multiples valuation gives us 38, discounted cash flow model gives us 92, and DDM valuation gives us 51, which is currently 21% higher than the current trading price of Altria Group. Now, if we want to plug in the margin of safety of say about 15%, which is the general margin of safety I always go with, this would give us an acceptable buy price at $45.86, which would currently be a buy. Now, if you don't yet have Altria Group in your portfolio and you're thinking about adding it, this might be the best time to add it. If you found the spreadsheets interesting or helpful, make sure to subscribe because in the future I will be making a video on how to create interactive spreadsheets such as this. With that, make sure to leave a like and let me know down in the comments which stock you would like me to evaluate next.